Some of me know I'm a pretty grumpy accountant. I was actually thinking of buying the domain name grumpyaccountant.com. And of course I'm too cheap to spend the $12. I'd like to start by quoting a few lines from my favorite Beatles song. Can anyone guess what that would be? How did you know? I'm just going to quote a few lines, okay? If you drive a car, I'll tax the street. If you try to sit, I'll tax your seat. If you get too cold, I'll tax the heat. If you take a walk, I'll tax your feet. I think in Canada we sometimes feel like this, right? All we do is, anything you do, you pay tax. You move a finger, there's going to be a finger tax. You walk, there's going to be carbon tax on the air. You can't even breathe without paying tax. All we do is pay tax. So every night I lay awake in bed and I'm depressed about this. But I think, hey, at least it's not North Korea, right? So let's talk about tax, okay? We're going to talk about a bunch of different things. I'm going to throw it quickly because I don't have a lot of time. We'll start with principal residence. So everyone knows when you buy a house that you're living in, when I say house, condo, townhouse, whatever, the place where you live, your home. This is, if it's your principal residence, it's where you reside and you live there. When you sell the house, you don't pay any tax. Usually, when you sell anything more than what you paid for it, you have what's called a capital gain, right? Everyone knows this. So let's say I buy a house for $1 and I sold it for $5. My capital gain is $4. That gets included in your income, and you have to pay tax on half of it. So half of it's tax-free and half you pay tax. When it's the house that you live in, you pay no tax on that, okay? Now, what if you're a first-time home buyer? A lot of you put up your hand that you already own a house, so this may not be relevant, but you might know people. Make sure you claim what's called a first-time home buyer's tax credit. Okay, that's on your personal tax return. I believe that all tax credits and all deductions should be abolished, and we should just lower the tax rates. But this is the system we have, okay? So when you file your personal tax return at the end of the year, you have to claim the first-time home buyer's tax credit. Also, when you close the house, there's something called land transfer tax. I'm sure everyone knows about this. When you're a first-time home buyer, you get a rebate. So don't forget to tell whoever's dealing with your closing that you're a first-time home buyer, you get this rebate. There's a new thing starting in the 2016 tax year. A lot of people are not aware of this. I don't know, maybe they are, I don't know. But when you sell your principal residence, it always used to be that you did not have to report this on your tax return. It's a tax-free sale. The government doesn't need to know about it. You sell your house, no problem. Starting 2016, you have to report it on your tax return. You have to disclose it on Schedule 3, capital gains. Now, it's still tax-free, but you must report it. Okay, we live in 1984, George Orwell. The government needs to know everything. You don't forget to report this, okay? Make sure you tell people. It's not a lot of people knows about it. So and there's penalties if you don't disclose it and they find out. Like you have to spread the word about this. Okay, so that's principal residence. What if you rent out your basement? I have a client who asked me, I want to rent out my basement, but I'm worried when I sell the house, it won't be my principal residence anymore because I'm now earning income from the house. So how can it be tax-free? So the CRA takes the position, if it's only a small part of your house, you're not renting out the whole house, you're not renting out half the house. If it's a portion of your house, then it's okay. You still get the principal residence exemption. The same applies for home office. All my clients, I want to claim the home office section, $100 million, claim a home office. Like everyone wants to go crazy with the home office section. So you have to be careful with home office. If you claim more than 20% of the house as your home office, the CRA is going to say, well, it's not a home office, it's an office. It's an office home. So you have I should leave on a high note, right? I should just sit down. So you have to be careful. Home office, you don't want to claim more than 10 to 20%. Like you don't want to go overboard. Now in my house, we rent out our basement. My wife actually didn't want to rent out the basement, and I insisted on it. And everyone says, before you get married, your wife is always right. You want to have a happy marriage? She's always right. I don't agree with that. She's right, I think 90%. She's not here. Some of you know her. Don't tell her I said that. I think it's 90% that she's right, and then 10% I'm right. I'm the accountant. We're renting out our basement. That's the end of the story. So we rent out our basement, but I also have a home office. As no one knows, I used to be in North Space, but I really don't like changing out of my pajamas in the morning. So I work from home in my pajamas. So I have a home office, and I have a basement rental. So now that's actually a problem, because if you're doing home office and you're doing basement rental, the CRA could take the position, this isn't a principal residence, you're running like a million different businesses here. So now actually I'm starting to, I have to decide I might not claim home office anymore for myself. And that's a small deduction. It's obviously much more valuable to have the tax-free capital gain when you sell your house. So you have to look at all those things. Okay, let's talk about Airbnb. Does anyone do rent out stuff in Airbnb? Anyone? Or thinking about it? No one, some people. Airbnb. So, Airbnb is, you must report the income you earn from Airbnb as income on your tax return. Same with the basement apartment. I forgot to say, let's say you're renting out your basement. You have to show, technically, you have to, I'm not telling you what to do, but what the CRA says you have to do, you have to show the rental income on your tax return, and you're entitled to deduct all the expenses relating to that income. Property taxes, insurance, utilities if you're paying, mortgage interest, only the interest portion is deductible. What else? Property tax, insurance, repairs and maintenance, any legal fees, commissions, you're entitled to deduct all of these expenses. Airbnb, it's the same thing, it's income. You have to show it on your tax return. Where people get hit with Airbnb, and what the CRA is cracking down on, the CRA is now colluding with Airbnb and getting the data. HST is a big issue. When you rent out your basement, or if you have a rental property, like you own a condo, you rent it out to just one person, you have a long-term lease, there's no HST on residential rent. But Airbnb is not considered residential rent. It's like a hotel. If you go to a hotel, you pay HST on a hotel in Ontario. So if you're renting on Airbnb and you earn more than $30,000 in a year or in 4 consecutive fiscal quarters, you have to register for an HST number and you must collect HST. So I have a friend who does this. He has a college in Muskoka. He rents it out on Airbnb. It's fully booked, like every day, April, May, June, July, August, September. It's crazy. He does really well on it. But he must report. So he doesn't show on his Airbnb listing, he doesn't show the price plus HST. It's just included in the price, but he backs out that 13%. So you have to be careful with Airbnb. If you're under 30,000, you're exempt from HST or small supplier. You don't need to worry about it. Okay. People always ask me, should I incorporate? Everyone wants to incorporate. They want to incorporate, put a rental property in the corporation. So the problem is, now some people do that for legal purposes, liability. Maybe we'll talk about that a little bit. But from a tax perspective, people think they want to incorporate because the corporation is a small business corporation. If you're earning what's called active business income, is taxed at a low rate of 15%. That's actually going down to 13.5% in January 2019. We can thank Bill Morneau for that. And it's actually going to go down further because Ontario is reducing as well. But that's if you're doing an active business like architecture. Or Ben, I don't know, whatever you do, I'm not exactly know. So they're like,
burn on my record. It's okay.
Okay, yeah. So let's say you're doing an active business, that's 15%. Rental income is not considered an active business. It's passive income, it's investment income. That's why everyone wants to have it, because they don't want to do it, no one wants to work anymore. I don't want to work, my dream is to earn passive income. I admit it, and most people don't admit it. Oh, I want to work. I mean, no one really wants to work. So, but the CRA taxes passive income at 50%. If you have a corporation and you earn interest income in a corporation, that's taxed at 50%. Rental income is the same thing. You get to deduct all the expenses, but the profit will be taxed at 50%. So when people ask me if they should incorporate, I always say it really depends. If you're already in the highest tax bracket personally, then you'll actually pay slightly less tax in the corporation because the highest tax bracket in Ontario right now is 53.4%. That's any dollar above $220,000 in Ontario is taxed at 53.4%. So rental income is going to be taxed in the corporation at like 2% less than that. But if you have zero income personally, let's say you have no income, and you want to have a rental property and the profit's only going to be $20,000 a year, for sure you should own that personally. Because you'll only pay tax of maybe $1,000 to $2,000 personally, whereas in the corporation you'll pay $10,000. So incorporating may or may not make sense. Okay, U.S. real estate. People sometimes ask me, I want to buy real estate in the U.S., so how does that work? So you might have U.S. tax filing obligations. You have to speak to a U.S. accountant. Because every state also has different rules. So you have to be very careful when you invest in U.S. real estate. You're going to have to file something in the U.S. if you're not a U.S. citizen or U.S. resident. You still have to file some type of return. I'm not a U.S. tax guy, but I can refer you to someone who is if you need that. The other thing about U.S. real estate is in Canada, the way our tax system works, if you're a Canadian resident, you must report on your tax return your income from everywhere in the world, okay? It doesn't matter what country you earn the income from, you must report it on your Canadian tax return and include it in income and pay tax here. So that would be the same thing for U.S. real estate. You have to show that just because it's in the U.S., you still have to pay tax here. If you pay tax there, you get foreign tax credits here. You won't pay double tax. There's something called a tax treaty. Most countries have tax treaties. Okay, so that's U.S. real estate. Also, you have to file what's called a T1135 form. That's very important, okay? Foreign property that costs $100,000 or more, you have to file a form called T1135. It's separate from your personal tax return, and there's very onerous penalties if you file it late or if you don't file it. So you must report any foreign property that you own, unless it's personal use. Like all these old people who own condos in Florida, if they don't rent it out, they don't have to declare it. But if they're renting it out, they have to show it on this form. The last thing I'll talk about is flipping. I think someone alluded to flipping. If you like flipping houses, flipping condos, and you think you're going to get a capital gains treatment because it's like investing, you buy it. Pardon? Income. Right. If you're doing it too much, if every day you're buying and selling a new condo, they're going to tax it as business income 100%. To get capital gains treatment, it has to be very infrequent. Like you buy it, you rent it out for 10 years, and then you sell it, and it's the only one you ever did, you'll get capital gains treatment. But if you're every day you're buying and selling a condo, that's going to be fully taxable business income. The last thing is MPAC, property taxes. If you get your MPAC assessment for the value of your house, and it shows that your property taxes are going to increase whatever, you can fight it. You can ask for a reassessment. You could say, what are you talking about? Didn't it go up in value? I don't know what's going on here. And a lot of the time they'll accept it and they'll reduce your, so that's just something to keep in mind. When you get that MPAC assessment, don't throw it in the garbage, okay? You have to look at it and you can fight it. So you got to fight the tax man, okay?